And we have another opportunity to do business in 55 minutes. Today on this episode of Business Incorporated, here's what we have prepared for you. We'll start all the way in Kenya, where that finance bill is still causing controversy and protest. And then we'll come to Nigeria, where the country's public debt stock is up, and that's up 24.99%. Ethiopia seems set. They're going to have their central bank digital currency. Good afternoon. Welcome to the program. I'm Ini John Mekwa. We start from the global space. As usual, we're telling you that crude oil futures slid in early trade on Friday on prospects of higher for longer interest rates in Asia and the United States, while falling U.S. oil inventories kept prices from moving lower. Brent futures for August delivery dipped 11 cents to $85.60 a barrel. U.S. crude was down also 9 cents, $81.20. Japan's core consumer prices last month gained 2.5% from a year earlier, according to data, growing from the previous month and keeping the country's central bank on track to raise interest rates higher in the coming months. U.S. data released on Thursday also showed that the number of Americans filing new claims for unemployment benefit fell in the week ended June 14, with broader strength in the jobs market persisting. Still, strong employment raised the prospect of the United States Federal Reserve could leave rates higher for longer. Oil was supported also by government data released on Thursday that showed a drawdown in U.S. crude stockpiles by 2.5 million barrels in the week ending June 14 to 457.1 million barrels. And this number is according to the Energy Information Administration. Gasoline inventories also fell 2.3 million barrels to 231.2 million barrels. And the EIA said that we compare this to forecast of a 600,000 barrel build. We stay in the oil area, but back in Nigeria, NNPC, Total Energies JV, has officially announced a $550 million USD final investment decision on the Better Field Development Project. This is in line with President Bola Tinubu's presidential executive order on oil and gas reforms and is aimed largely at improving the investment climate and positioning Nigeria's preferred investment destination for the oil and gas sector on the continent. At the signing ceremony, which was held at NNPC Towers, the Group Chief Executive Officer of NNPCL, Mr. Mele Kyari, highlights the continuous support of the President's administration in facilitating a conducive operational environment as a major enabler in achieving this success.
This project will create opportunities, jobs, and everything that you can imagine, including making our investment in the NLNG much more productive. I know for sure that the engagements with our other partners will ensure delivery of gas sufficient to keep our train 1 to 7 active and at full capacity, and also realize our ambitions for the train 7. I believe that the ongoing processes will deliver all this. And also not for this moment to speak, but we must say that collaboration with our partners has been of fundamental value to all of us. And finally, as we do this, yes, we can take a sanction, we can take a project, but you must produce the gas. And of course, very often, not just for this project, but even for other projects, you must also produce the oil. We have seen the huge challenge that exists today in our business environment, and NNPC has taken one more step today. We have launched a war against crude oil production. Not against, war to uplift production. We have set up a war room. We are seeing it as a fight that we must all win to the benefits of all of us, all our partners. And we'll leave nothing unturned. Every obstacle on the way, from security to investment to any other obstacle that on its way. We'll work with our partners to pull that out and intervene in every way possible. And I also want to add that we have the full support of government to go in this direction. to the extent that we will secure these lives, the pipeline, in the first instance. And every other intervention that is required to ensure that production comes to normalcy, while we look forward to growth in the coming months, will happen.
Mr. Kieri sounding very determined there. Now let's leave the oil and gas sector and go to metals. Gold prices were poised for a second consecutive weekly gain on Friday, driven by safe haven demand amid tensions in the Middle East and rising bets that the United States Federal Reserve might reduce interest rate later on this year. Spot gold was up 0.1% at $2,360.95 per ounce after hitting a two-week high in the previous session. Bullion gained over 1% so far for the week. U.S. gold futures rose 0.2% to $2,375.60. On Thursday, several Israeli air strikes in the Gaza Strip killed at least 14 people and wounded dozens of others. The next market focus is on the United States Flash Purchasing Managers Index, which is due later on today. Spot silver fell 0.4% to $30.60 per ounce. Platinum was up 0.4%, $982.45, and palladium gained 0.8% to $930.98, and metals were headed for weekly gains. Now, here in Nigeria, the latest data released by the United Kingdom Home Office has revealed a 38% decline in study visas issued to Nigerians between March 2023 and March 2024. The report particularly focuses on the decline in the number of study visas issued to applicants from India and Nigeria, which are UK's two major markets for study visas. Visas issued to applicants from India fell by 16% for the same period. And study shows the decline appears to be closely tied to the rule change in January 2024, which now restricts international students from bringing dependents unless they're enrolled in research-focused studies. The continuous exit of multinationals from Nigeria remains a huge concern to the Nigeria Employers Consultative Association, NECA. And to stem this trend, the Director General, Mr. Smart Oyerinde, believes that it requires the concerted effort of both the public and the private sector. However, the government has to take the lead.
Every agency, every ministry, all departments of government, both at the federal and the subnationals, they must all work in harmony so that we reduce the contradictions that we find in this economy. And those are key issues. One agency of government or the federal government cannot be promoting job creation, and another agency of government is also creating bottlenecks for job creation. We cannot say one agency of government is promoting ease of doing business, and some other agencies of government or level of government, they are also creating bottlenecks for ease of doing business. Everybody must work in harmony so that we are not communicating different messages to the international community. The international community, they are listening, they are watching, and they are receptive to coming. But those issues, those big and salient issues about the regulatory environment, about the tax environment, even about security, we need to deal with them because those are fundamental issues. Not to mention the issue of the justice system. If your justice system, your legal system is not strong enough and it doesn't give an investor the guarantee that when there are issues, the legislative system will deal with the issues and deal with it without partiality, then it becomes difficult for them to come.
But still in Nigeria, where the Debt Management Office says that the total public debt has increased significantly to 121.67 trillion naira, that's approximately $91.46 billion as of March 31st. And that's up 97.34 trillion naira recorded in December 2023. In this latest report, the DMO explains that the figure comprises of combined domestic and external debts of the federal government and the 36 state governments, as well as the Federal Capital Territory. The DMO says 24.99% debt increase is driven majorly by naira devaluation, as the total debt was reduced in dollar terms by $16.77 billion. That's about 18.34%. At the same time, the debt office attributes the increase to new borrowings undertaken by part finance of the 2024 budget deficit and the securitization of a portion of the 7.3 trillion naira ways and means advances from the Central Bank of Nigeria. And still coming from the government, the amount of net foreign exchange inflow into the country's economy was down 39% month on month to $2.37 billion in January from $3.91 billion in December 2023. According to the Central Bank's monthly economic report for January, released on Thursday, the sharp decline in net Forex inflow was caused by a 95.7% month-on-month increase in Forex outflow from the economy. The CBN report mentions that aggregate foreign exchange inflow into the economy decreased by 6.1% to $4.87 billion from $5.19 billion in the previous month. It also points out that the sharp decline in net Forex inflow in January reflects the Forex scarcity that triggered 60% depreciation of the Naira in the official market within the month in review. And the federal government says it is concluding the process for establishment of Electricity Offences Tribunal to tackle power-related offences. The managing director of the Nigerian Electricity Management Services Agency, NEMSA, Mr. Aliu Tahir, who made this known at the press briefing, explains that the move, which is in line with the agency's mandate, aims to ensure swift prosecution of offenders and uphold the integrity of the nation's power sector. He also highlights that the National Assembly had been informed about the initiative and that the new tribunal is expected to streamline this process and allow quicker enforcement and penalties, while noting that the current process for sanctioning violators under the Electricity Act is cumbersome and slow. Mr. Tahir emphasizes that the tribunal would speed up the resolution of electricity-related cases and enhance the enforcement of capabilities of NEMSA. Let's take a break now. When we come back, we'll head to the market. And of course, we have our eyes on Kenya. That conversation will come on later. Just stay with us. Welcome back. Still watching Business Incorporated on Channels Television. We head to the markets now. Yesterday was a very busy one for the NGX. Aniti, even though we saw that the market was almost unchanged, still 0.00, even though the market gained $1 billion naira. But there was a whole lot happening. We had that Fidelity right there. We had FBN Holdings, you know, the move by Mr. Otedola again on that stock. And it was really a busy day, and the banks are getting all the attention. Exactly.
The banks certainly will be getting more of attention because Fidelity Bank was the first to make that the rights issue and the public offer, talking about the public offers market. So that, of course, rubbed on the counter. We saw approximately
0.72% increase at the close of trade. I wonder what it looks like at this time, but anyways, we'll see at the close of trade, see what the banks will do again today, especially eyes on Fidelity Bank.
Eyes on Fidelity Bank, as well as FBN Holdings.
FBN Holdings, yes.
Because,
the move.
Exactly. Of course, that's Nigeria's oldest financial institution. So we'll be looking out for how that turns out. Okay, so now let's take a look at the market at intraday. For Nigeria's stock market, it's again 0.11% and almost the same for the South Africa JSE, two of the continent's biggest markets. There we see there the 99,000 points is still oscillating in between that level and 100,000 points. So we'll be looking out for how that market closes for Friday. But for South Africa's stock exchange, it has been able to maintain that 80,000 points level, which it just crossed about 2 days ago. So this is the market snapshot at intraday. Now, for the other side of the market, we see Egypt Stock Exchange still very much on holiday. This is the figure that we had since last week. So they're still reveling in that the Eid holiday, which was celebrated across most parts of the Muslim world, which Egypt is majorly a Muslim country. So this is for Thursday. And for Kenya, where we see the NSE All Share Index as the Nairobi Stock Exchange at intraday, or actually for Thursday, was up by 0.90%. So that's it for that market. And now we still come back to Nigeria and talk about the fixed income market, where we saw first for the Treasury bills market, it closed on a bearish note. Average yield there expanded by 10 basis points to 21.9%. Across the curve, the average yield advanced at the short and long ends. This was largely driven by sell-off on the 35-day date to maturity and some other papers there. But for the bonds market, it was also a similar bearish sentiment there. Average yield there rose by 10 basis points to 18.7%. Now, we're going to be talking about the FGN bond auction, which was initially scheduled for Monday, but it was moved to Monday next week because of the public holiday, where we see first a breakdown of the bond offer. Actually, the government is targeting about 450 billion naira from the June bond offer. As you can see here on the board, 150 billion naira at 19.3% for the FGN April 2029 5-year reopening. And for the February 2031, we see the same figure across the 3 instruments being offered there. A 7-year reopening as well as a 9-year reopening for the 3 instruments there. 4 different dates of maturity. And the offer will be opening on Monday, as announced by the Debt Management Office. So now let's get a deeper perspective on this. And we have Raymond Okpara, Senior Fund Analyst at AfriVest West Africa, to give us more details about this. Thank you for joining us, Raymond.
Yes, thank you so much. I'm nice to be here.
Okay. All right. So now let's talk more about this FGM bond auction. First, we had the savings bond auction, but this is the bigger side of the auction. And of course, government borrowing so far. This is half year. So now can you give us more details about this and your expectation for the upcoming bond auction for the 6th month of the year?
Okay. Just for the bond auction yesterday, as we were expecting bond auction to come on Monday. But even more importantly, we've seen yields higher for longer in the market. Yields even on the new reopening at 19.8%. And this just highlights something for markets. It highlights that yields will remain higher as long as inflation remains higher. And this is in tandem with the CBN's, hawkishness through the course of the year. But also, even more surprisingly, we got some reports from the Debt Management Office, which points to direction of borrowing for the government, and that's also comprised of the total debt that the government has raised so far, even up to March, and from that data, you saw that domestic and external debt, has approximately grown to 121 trillion naira as at March, coming from 97 trillion as early as December last year. And when you disaggregate this data, we'll see that the domestic debt rose by 6 trillion, majorly on the back of, borrowing for financing the 2024 budget deficit and also securitizing the 7.3 ways and means advanced by the CBN. So you can also see that the DMO is leaning to the side of domestic borrowing, as we've seen that, hitch. We've seen some obstructions based on sovereign-specific factors that have affected borrowings in the external market. So we believe that, the auction on Monday, will be heavily subscribed as usual, and this is a milder way to raise capital, for the government over the course of the period.
Okay, so now this latest bond offer, is it having any particular impact on the overall economy? When you take the Nigeria's current debt level, which is over 121 trillion naira, so is it having any positive impact on the market, not just for investors?
Definitely. For borrowings, for Nigerian solvency, it's understood that we'll look at debt analysis from 2 major angles. Firstly, solvency, which takes a more long-term approach, and secondly, liquidity, which considers short to medium obligations. And on Nigerian solvency states, the recent numbers show a worrying picture. We've seen debt stock to GDP ratio further deteriorate. From our analysis, debt stock to GDP jumped from 41.51% in December to as high as 50.46 if you calculate the numbers even announced yesterday. And understanding this, Nigeria has typically breached her self-imposed 40% threshold set by the DMO and is much closer to the 55% debt stock to GDP ratio for developing countries set by the IMF. And while there's a conversation on, what debt stock does for market and why should it be a major indicator, it's understood that GDP is a major proxy for economic activity, because we understand that if economy is working optimally, the government tends to realize more revenue to support expenditure. And on the second side of this liquidity analysis, talking to, the liquidity side, the more short-term side, the more short-term side, it's almost likely that Nigeria faces a debt trap, as debt servicing to revenue ratio ranges at the upper 60% levels. And we've seen that, across, the last 2 years. But don't get me wrong, accumulating debt is never a problem. It's not a problem as far as GDP growth supersedes debt growth. What we see, the government typically needs money to finance economic activity. But when there's a disconnect, there is a problem. From the recent numbers, debt stock has grown above about 25% in the past 3 months, while GDP calculated, with the Q1 run rate has grown by only approximately 3%. So it's therefore important that something drastic needs to be done by the government on revenue generation and economic growth to wholly stabilize the economy. The focal point for us will be prioritizing enhancement of business environment across board, the corporates, the SMEs, so at least supply side issues are reduced to the minimum, and also we are able to attract, more foreign players into the Nigerian space. And for your second question on investors, typically, as we've seen inflation skyrockets, we also understand that this has presented, higher yield for investors across board. You see treasury bills offering as high as 24% on per annum, and also the bonds market, offering very good yields up to 19% ranges. But in the case of the government, we also understand that this typically increases the cost of borrowing, which further puts a strain on government balance sheets, like I highlighted earlier. But for investors, it's very important that whatever they do, they keep an eye on safety. Okay. We can go.
Okay. So Raymond, before I let you go, just about 20 seconds. What's your expectation for the final 5 trading days of June for the fixed income market instruments, both the treasury bills and the bond?
Okay. Historically, starting from the beginning of the year, we saw the Nigerian treasury bills market and the bond market, trade in a bearish momentum. Because of that was just the inception of CBN's hawkishness to, keep a hold on interest rates. But so far, we've seen that rates have been kept higher for longer. Like I mentioned, cost of borrowing is a problem. So the government will try as much as possible to keep the rates as a sustainable rate, which will not affect their balance sheets. So we expect, yields to trade in this band, the 19 levels for the bond market, and also on the treasury bills market, we've seen, that 20% levels, 22% levels on discounted rates, which will give a yield of about 24% for the foreseeable future, till things change on the inflation side and also on the monetary policy side. We understand that, even with the CBN's target of 23% or 24% inflation target, it's still a far cry from where we are. And as far as the CBN is still hawkish and maintaining their hawkish stance, yields will remain elevated.
Okay. All right. So thank you so much for that splendid analysis, Raymond. And of course, we keep our eyes on the market, equities, fixed income, and other sides of the market. But thank you so much for your analysis on our show. So that was Raymond Okpara, Senior Fund Analyst with AfriInvest West Africa for the fixed income market. And now from Africa, we move to the Middle East, where we see yesterday at intraday, we had seen the United Arab Emirates, which is still in trading. At intraday, it was in the red, but this time, today's intraday, in the last 3 trading sessions so far this week, it had been in the red, but thankfully, at intraday today, it's 1.07% in the green for the Abu Dhabi and 0.44% for the Dubai FM, both on the United Arab Emirates. On the other side of the market, we see Saudi Arabia still in holiday as at last week, Thursday, which is today is supposed to be the final trading day for them, but they're still reveling in that holiday, which they started since last week. And for the Qatari Stock Exchange, it closed for Wednesday's trading session. Actually, is actually on holiday for Thursday. So, but the last tracking is 0.16% in the green at 9,702.14 for the Qatari Stock Exchange. And from the Middle East, we move over to the United States, where we see this color for the stock futures, the Dow Jones Industrial Average, as well as the S&P 500, 0.13% for that market. And for the Dow Jones Industrial Average, 0.15%. For the NASDAQ, the tech heavies, there's still a 0.06% in the red. Now, these markets, they were, as yesterday, no thanks to the sell-off on the side of NVIDIA, which has now become the darling of the markets, particularly on the NASDAQ. So these markets were tracking some of that losses. NVIDIA, sometime earlier this week, had overtaken Microsoft as the world's most valuable company, and a couple of months ago had overtaken Apple as in terms of market valuation. But the markets will be looking out for some key economic data due out from the United States later today at about 2:30 p.m. Nigerian time. And finally, for the Asian stock markets, we see stocks mostly falling after a cooler than expected Japan inflation data, which you see has dropped off on the Nikkei 225 at 38,596.47. It was down by 0.09%. For the South Korea's Kospi, 0.83%. And for the Hang Seng Index, 1.67% in the red. So that's it. Speaking of Japan, the U.S. Treasury Department had placed the country on its currency monitoring list, but did not classify it as a currency manipulator because the yen has been in some kind of, at some point it had fallen to some multi-year lows, but that country is still facing some kind of economic, some mild economic challenges. So at some point, it should be able to rebound. For the Shanghai, we see it in the red, 0.24%, and for the Australia ASX 200, 0.34% for the close of Friday's trading session. So that's it for Asia market and the other markets as well.
Thank you so much, Anity.
Pleasure.
All right, now let's go to Berlin, where China seems to be receiving a lot of knocks. Today, it's from Italy. Italy's competition regulator is fining local car companies for allegedly trying to pass off Chinese-made cars as homegrown. That's for Italy. Well, let's get more on this with Cassandra Sons. Cassandra, good afternoon. So what more do we know about this regulatory action?
Thanks for having me, Inni. Well, the Italian government says that DR Automobiles misleadingly marketed their cars as produced in Italy, even though they were mostly made in China. The models we're talking about here are the DR and EVO brands. Now, DR Automobiles assembles low-cost vehicles using components produced by Chinese car makers like Chery, BAIC, and JAC. The regulator says that really only minor assembly and finishing work is carried out in Italy. The regulator adds that the practice of what it says is misleading advertising coincided with market growth in sales of the DR and EVO vehicles in the Italian market. The company, meanwhile, says that it would appeal the fine as it never claimed its vehicles were completely made in Italy, but the competition regulator has fined the car company €6 million as a result.
Yeah, so it doesn't seem like this is the first time, or is it, from Italy?
No, that's right. Dozens of Morocco-made Fiat Topolinos were recently seized in the Italian port of Livorno because they had an Italian flag insignia. At the time, Fiat's parent company, Stellantis, said it had followed regulations but has since removed those flags from the vehicles. Then back in April, another Italian brand under Stellantis, this one Alfa Romeo, renamed one of its brands, formerly known as Milano, though it wasn't made in Milan. It was made in Poland. That car has been renamed the Junior, and that followed pressure from authorities as well. And all of this comes as Europe looks to impose tariffs on Chinese-made EVs, which can be produced much cheaper than European brands due to Chinese state subsidies. At least that's the way the EU sees it. Now, these new tariffs, combined with already existing penalties, can mean that some cars, if imported into Europe, could be as much as 50% more expensive than the original sticker price.
All right, let's look at investors now. How are they doing, faring at this time?
Well, so far, technology shares were really sagging on the open, and that was having an effect on European markets. The Pan-European Stock 600, for example, was down 0.2%, and it was the tech sub-index that lost 0.6% earlier today. So some impacts there, even though the tech index did rise 2% on the previous session. But I would say that the European benchmark was still on track for modest gains at the close of this week after dropping more than 2% after French President Emmanuel Macron called for a snap parliamentary election last week. Meanwhile, in Paris, the CAC 40 lost 0.3%, and in Frankfurt, the DAX was down 0.2%. In London, the FTSE 100 was down a tick, losing 0.1%.
All right, Cassandra, thank you so much for the week. Do have a great weekend. Now let's get to Kenya. I think that's the country of the week for Africa because of that protest on the finance bill. It's been causing a whole lot of chaos. Even after the 16% bread levy was removed, the protesters are still, asking for more. Let's try to get the update and perhaps a bit of balance from someone who is there. Dr. Debisi Araba is a public policy and innovation and strategy specialist, and he specializes on the future of food and the environment. So we expect to get that perspective from this controversy or protest going on right there. Dr. Araba, good afternoon, and thank you for your time.
Well, thank you very much, Ini. It's a pleasure speaking with you today.
Great. So I did see a report saying that the protesters are being probed and things like that. How is it for now? Is the protest still on? Are people being arrested?
Well, this is the voice of the people being amplified. The people are speaking, and they're speaking very loudly, and it's our expectation that the government listens. Of course, we have received news from the government that within the finance bill that was passed, the 16% value-added tax on bread, the tax on transportation of sugar, tax on financial services, foreign exchange transactions, as well as, crucially, the 2.5% annual motor vehicle taxes have been removed from the bill. Why is this happening? Well, it's happening because Kenya needs to increase revenue, or the government needs to increase its revenue, and so it's looking for avenues where it can levy its fiscal policies to increase taxes. My biggest concern in this is as it relates to food and food security. Kenya has high to moderately high food insecurity. At least 20% of the population, over 13 million Kenyans, go to bed daily hungry without having adequate food or nutrients or nutrition. So when the government then picks on a staple, bread, to increase taxes, what that does is, of course, increase the price of the commodity in the market. Of course, when you also tax transportation of sugar, which is an ingredient in a lot of foods, you're increasing the prices of food. So it's important, even as the Kenyan government looks to increase revenue for public expenditure, it takes a holistic view on how it does this without compromising other aspects, right? I would say a healthy population is a prosperous population. A prosperous population can pay taxes, but when you compromise the health and prosperity of your nation, then of course you inadvertently compromise the ability of these people to pay taxes now or in the future.
But the 16% on bread and transport, they've been suspended. So what else do the people want? Why are they still on the streets?
There were other aspects of the finance bill, too numerous to mention. And so it's effectively the Kenyan public or the youth. It's really driven by the youth. That's not to say it's just the youth who are opposed to this, but the protests that we've seen over in 2 days were driven largely by the youth. And it's because they feel that their future is being compromised. And so if they are old enough to elect the public servants, then the public servants should be working in their interest, not against them. And so I think the Kenya, I'm a big fan of Kenya as a country. I love this country. I think they had very strong institutions, a listening government, a government that responds to the will of the people, and the will of the people is being expressed. So there's absolutely nothing wrong with the people expressing their objections, strong objections to the finance bill, and it's their will for the entire finance bill to be expunged and then have a discussion from the ground up on what it means to build up revenue for the government, but also what kind of taxes are appropriate for every segment of society.
So, I mean, you said that the government needs to raise revenue. So how do we find a balance here? I'll give an example with Nigeria. With Nigeria, what is needed the most at this time is expanding the tax net and not even increasing taxes, even though I think the IMF or the World Bank has advised that be done, but getting more people into the tax net. And you said Kenya has a strong institution. So do you have people who are supposed to pay taxes? Are they paying taxes? Is it getting to the government, or does it have leakages? Perhaps that's why the government is being aggressive at this time.
I believe, yes, Ini. I believe that's one of the things President Ruto's administration is looking to do. Widen the tax base, but also plug those leaks. A lot of economic activity happens informally, and so it's also about trying to put on top of or underpin this informality through formal structures. So that was possibly one of the reasons why they were exploring the taxation on mobile money transactions. Now, I must say for Kenya, in Kenya's defense, that Kenya is quite innovative in financial services, but also in thinking through social safety nets. We remember at the onset of the pandemic in 2020, the Kenyan government, in collaboration with Safaricom, the mobile operator that powers the M-Pesa, the mobile money transaction platform, they suspended transaction fees on person-to-person or peer-to-peer transactions below 1,000 shillings, and also increased the amount of e-money that could be held in individual wallets. And what did that do? It enabled people to continue financial transactions, so you didn't have to physically go to a bank or hold cash. And so even if people who were urban dwellers in the cities could still send money to their loved ones in villages, and feel that people could make it through the pandemic. And so that level of innovation, I think, we need to call back to that. The same Kenya that came up with that level of innovation that saw us through the early parts or the first trimester of the pandemic in 2020, I think that level of innovation needs to come back to see how the government can widen the tax base without compromising people's economic aspirations.
Yeah, and there it was back here in Nigeria, because I think I did read a story about the tea farmers and some efforts being given to them, making it more profitable for them, and exports in Kenya increasing. So, I mean, there I was thinking, this is spreading and it's good vibes and good for the economy. So seeing all of this and hearing from you saying some Kenyans actually go to bed without food, I think it does call for some very desperate moves.
Yes, it does. And I think the Kenyan, both the government, the civil society actors, everyone involved in moving or shaping public policy have it in them to derive and design what will be beneficial for Kenya's long-term prosperity. Speaking about Nigeria, I think, again, I'm calling back to in 2021, the world gathered to discuss a food system summit, to look at food not just in an agriculture context, but the wider context of systems thinking. A lot of things impact the food that we eat. For example, raising taxes on transportation will impact the cost of food, either imports or duties, levies, etc., tariff and non-tariff barriers. And so it's this holistic thinking that is required, both for Kenya and Nigeria. Nigeria, as we know, has runaway food inflation, over 40% at this point. The Nigerian government, just like the Kenyan government, needs to rethink its fiscal policies to ensure that even as you're either raising revenue or designing these policies or your tax regimes, you are not inadvertently importing inflation into food systems, but also ensuring that your population is nourished. People have access to healthy, safe, nutritious food. It's available, it's accessible, it's affordable. These are the cardinal points of any government. I think it's the bare minimum that any government needs to achieve before they move on to the bigger aspirations for human productivity.
Yeah, thank you so much, Dr. Araba. Sounds like a common thread running around most African countries, unfortunately, and basics are being, squeezed. But thank you so much for sharing your perspective and update on that with us, Dr. Debisi Araba, joining us this afternoon.
Thank you, Annie.
Now let's go to Uganda, where that country has emerged as the top destination for foreign direct investment in East Africa community, as detailed in the 2024 World Investment Report by the United Nations Trade and Development. Foreign investment in Uganda in 2023 were estimated at 370 billion shillings. In particular, Uganda was reported to be among the few countries that have adopted a digital single window model that makes it easy for businesses to register, get clearances, and pay taxes. Conversely, Kenya, we just talked about, has similar technology. However, it did not cover county government, where investors are also required to apply for licenses before setting up shops. And as part of plans to liberalize the country's financial landscape, Ethiopia's Council of Ministers is moving towards introducing new banking reforms, with the incoming rules hinting at commercial rollout of central bank digital currencies. We call it CBDCs. The ministers have given their consent to two draft reforms: the Banking Business Proclamation and the National Bank of Ethiopia Proclamation. A close look at the content of both proclamations reveal a focus on improving the credibility of the local payment ecosystem, bringing them to par with modern realities. The proclamation dealing with the NBE is expected to strengthen the central bank for improved monetary control. The NBE's top priority is launching a CBDC pilot, but the central bank is expected to meet several checklists. For starters, the NBE is eyeing the establishment of legal framework to guide its CBDC foray and the launch of a regulatory sandbox to tinker with real-world use cases. Interesting right there. I guess it's important to also note that Nigeria is the first in Africa to have its own CBDC, the e-Naira. But that's a conversation for another day. All right, now let's head to crypto space and see what's happening there. And CBDC, I think, fits into that conversation real soon. But let's look at the numbers for Bitcoin, especially beginning with that. What a red board this is. I do wish Ladi was here to take this board, because it's so red, I feel it's going to stain my dress. Bitcoin is at 63,000. Imagine, just when I was about to come in here, it was 64. And I was like, this is really low. But now we've said it's even lower. 63,712.69, down 3.36%. All shades of red, or more, very deep shade of red is what we have here. Ethereum has also gone down that way. After days of surging, we see it's dropped 2.64% to 3,492.60, dominance 18%. So we hardly have the greens. So tiny right there. Very missable. I wonder what's happening. Let's have Solomon Amunde to perhaps share his thoughts with us on what's moving Bitcoin. And now Ethereum has joined. Ethereum was doing well, been doing well since last week, but seems to be catching up. The trend has caught up with it. Now, Solomon, good afternoon.
Good afternoon, Amy. Good afternoon.
This board is too red, Solomon. Look at it. When last did you see Bitcoin at 63? It might be a good time for investors to get in, but this is really low for, the king of crypto. And Ethereum now has joined, losing 2.64% in just a couple of hours, or I think an hour.
Yeah. It's actually been a while we saw Bitcoin this low, I think about 2 months ago. But then again, we're still expecting the price to go lower than it is currently. I mean, Bitcoin is still on the support right now. So if we go to 62K, then most likely we'd also see 58K. So this is a good time for investors to begin to DCA, although I would ask most new investors to hold on a bit till we see the low for this month before they can decide to start buying.
But how do we know when we've hit the low? We don't know if it just starts surging. We're still waiting for the post-halving surge.
Yeah. We would know. The only way we would know is looking at historical price. The last low we've seen this year, that was, I think, 2-3 months ago, which was $56,000. So it would be fair for investors to start to get in from 58K, 59K, and probably 60K, obviously by DCAing into Bitcoin. So that's the best way to be able to determine the low. Outside that, I would say if we go below 56K, then the next place investors should start looking at buying would be around $50,000. But currently, I believe Bitcoin would go below 56K. Personally, that's unbiased, yeah.
And then that surge will still come this year? The recovery?
Yeah, obviously. Yeah, we would still go above $80,000 this year.
Wow.
I'm almost sure, yeah. Towards the fourth quarter of the year, we should go above $80,000. But before that, the market needs to capitulate. And capitulation would be within the range of 45K and probably 55K.
Wow, 45K, that's really low. Do you have an idea, when you look at your graph and the historical data, how long it may take?
How long, we can't really say how long, but we can be able to attribute what has caused the pump we have seen. We can say it's based on the multiple ETFs we have seen, Bitcoin, Ethereum, and now we are seeing about Solana ETF. This has given Bitcoin that incredible pump we have seen this year. But the question is, can that be sustained till the fourth quarter of the year? I doubt, personally. I doubt.
So you don't think perhaps this is the alt season we've been waiting for since Bitcoin is getting hit?
Yeah, definitely. If Bitcoin goes below 60K, alt season would gradually get started because liquidity will start flowing from Bitcoin to altcoins. Right now, most altcoins are sitting on their lowest of lows this year. For most altcoins, they are all-time low for this year. So if Bitcoin can get below 60, that would be like the best thing for altcoins.
Okay. And let's look at this CBDC in Africa. Nigeria CBDC, I think, is sitting somewhere. I don't know how active it is. Now, we see Ethiopia going that route. Is it that the continent is not ready? Perhaps we're just doing it because it's the in thing now, or is there something you think we're missing?
Yeah, for Ethiopia, the National Bank of Ethiopia, they actually said the whole idea of the CBDC, the initiative, is actually part of their larger reform strategy, which is to actually modernize Ethiopia's financial framework, and also their electronic payment system help also to boost foreign investment and also to position them globally in the market for investors to jump into the country and make some good and credible investments. So I can say that there's an agenda for them, but I can't say how well they'll be able to execute this and long term how this would play out for them. But it's quite interesting that so far so good, they have approved it and they are waiting for ratification now from their House of Rep, because they've been looking into this since last year. So it's quite nice that at least about 8 months after they've been able to approve. So I would say it's positive signs for them.
Yeah, well, it might sound positive, but I guess with the experience of other African countries, you don't get so excited because getting it approved and even having people, convincing people to download and all of that is one thing. But is it a matter of infrastructure? Okay, let me just talk about Nigeria, for instance. Why is it not, with all the benefit that has been highlighted, why is it not active? What do you think?
I think it has to do with the value proposition. It's either it hasn't been properly communicated or the common man can't relate with how this is useful to them. Because truthfully, before you try to make use of a CBDC, you have to see the utility and the usefulness, the problems it helps you solve, and the advantage of using it. So if I would give an easy example, I would say if maybe they told Nigerians today that if you make use of CBDCs, you won't pay transfer charges. It's a no-brainer. almost everyone will start making use of the CBDC. That's the easiest relatable feature that anybody can actually relate with. So I think it's based on communication and value proposition. I feel that's where the problem really is.
Okay, well, we hope when Nigeria Central Bank will want to look that way again, perhaps they will highlight those benefits, those relatable benefits more to get people on it. But just before we let you go, Solomon, what do you see over the weekend for Bitcoin and the alts?
I think Bitcoin would have a relief bounce from around 63K where it is currently. But towards the end of the month, I still expect us to go towards $58,000. I expect us to try testing that one more time. And if we're lucky to close above 58K, then that would be a good sign. But if we close below that, that would be a more bearish sign for Bitcoin heading towards 50K.
All right, Solomon Amude, thank you so much for your time and your views this afternoon.
Thank you very much.
So that's it. Perhaps you want to hold on. That's if you're into cryptocurrency. You want to hold on and see if you have a better deal as Bitcoin goes down lower, so that when it comes up, you have more. It's up to you, and you might want to consult for that. But that's it on Business Incorporated for today. Thank God it's Friday. Now we can get into a weekend mood. Oh, I can't do that yet. I still have the stock market report. I'll see you at 10 p.m., but do have a great weekend. I'm Ini John Mekwa. Bye.